All right. Good afternoon, everyone. October 2nd, Brian Wilson here, market strategist for Market Structure Edge. I'm thankful that you're able to join me today. We have a few topics to unpack. As usual, all of your questions are welcome. You can either raise your hand during the demonstration or just hit me up on the chat line. I'll probably go through a couple topics at a time and then circle back in to see if any questions have come in. So once again, very thankful that you're here. If you could just stay muted during the discussion itself, I would appreciate that so everyone can hear what's taking place. Well, I'm going to start the discussion by let me make sure I didn't miss anything here at the beginning. Seb is just saying hi to everyone. Thank you, Seb. It's great to see you. I'm going to start the discussion by part of a note that I wrote this morning, talking about potential weakness from a broad market perspective and from big tech at the same time. We don't see it very often. It's why I mentioned it. And part of the concept is a concept that I call alignment. So let me show you what I'm referencing here. So this is what we call broad market sentiment. So here in blue is SPY. In green is what we call sentiment. That's our algorithm for demand. What stands out right now is that sentiment has come to a standstill, occurring right during a month-to-month, quarter-to-quarter transition. For about a week and a half, we've just been slowly grinding lower down to 5.1. So we're very close to neutral levels from a sentiment perspective. What I'd like to do is to take this sentiment read, and then I'd like to combine it with what's happening in big tech. And when I did this exercise this morning, it made me stop for a moment, and I took probably 15 or 20 minutes and just looked back at some of the data points. You know, what has me a little bit concerned? Well, it's the fact that big tech sentiment is declining at the same time, and it's moved below neutral. So let me show you, and I mentioned this in the note this morning, a few of the times where this has occurred during the last year. So I'll go back to our sentiment chart here and pull it up on a 1-year basis. So the times where this has occurred recently, and once again, what I'm referencing is instances where big tech has moved below neutral and the broad market has moved below neutral at the same time. We go back to make sure I have it on my end of November. So right in this ballpark, right in here. Sorry, right in here. So end of November, that was the last time or the first time it occurred here. Once again, we're looking at big tech below neutral and broad market sentiment below neutral at the same time. What happened here? It basically flatlined. So you can see SPY basically flatlining for a period of time. The next time that it occurred, it was the end of December into early January. Look at what happened here. You can see that there was weakness from a broad market perspective once again for a couple of weeks. We circle up to the early part of February. It once again occurred right about in here. We had a couple of days of upside, and then that's really when the market started to deteriorate. That was during February, right after the conclusion of February options expirations. It's part of why you hear us talk about inflection points. Well, both big tech and broad market sentiment were both weaker at that particular time. And in fact, look at what was happening from a sentiment perspective, looks very similar to right now. Sentiment had ground sideways, kind of what it's doing right now. So February, beginning of March, it did something very similar. Beginning of March, sorry. So we look at this time frame right back in here, and you can see the market was moving lower. And then the last time that it occurred, well, the beginning of April, right in here. So what do a lot of these have in common? Well, the market's either moving sideways, or in a couple of instances, we've had pretty significant weakness. Obviously, in March, that was the case. Obviously, in April, that was the case. These are central tendencies, so not every time is going to be the same. And I'll qualify it by saying we're not below neutral right now. But when I looked at the setup right now, that was what came to mind is, there's good potential that this structural setup right now might move below neutral. And if that's the case, what have we done in the past? Well, we've moved sideways or the market has moved lower. That's one of the risk that I see out there at this particular time. Recognize from a context standpoint, where are we right now? Well, we're in what we call a new month, new money trade. If we look back over the course of the last year, it's being met with new money about half of the time. These little squares here signify when we're coming up to a new month. You can see in early November, got a little bit of upside there. We look at early December, kind of limited upside. Early January trading, just very, very brief, more declines. Early February, broad market weakness there. Early March, well, the whole market was under pressure. Early April, same thing, whole market under pressure. And obviously the market's been in a tremendous run since the tariff drama back in April. What do we have in common during some of these periods? Well, as we come up on some of these month-end time frames, we're seeing limited downside, and then the dips get bought. Limited downside, the dip gets bought. Limited downside, the dip gets bought. It's been the last 4 or 5 months in a row. It's that type of activity. Little bit of downside at the beginning of the month, and then those dips have quickly been bought from a broad market perspective. I'll stop sharing for a second, see if we had any questions come in. Don't think we have, so I'll go ahead and continue. So from a big picture perspective, once again, where we're at right now is the fact that we're in the beginning of a month. And what we're seeing right now is something similar to what we've been seeing the last few months is, beginning of a month, sometimes you get those dips and they're getting bought. I did want to circle over for a moment to our Edge Focus portfolio. And those that are not familiar with this, it's a quantitative portfolio. It's available to those who are subscribers, and it's done really well this year. Just bottom line. It's a quantitative model. It's going according to certain criteria. Here's the criteria that's listed. It's sentiment or demand that's greater than 8. The trend is up. Dollars per day, at least 100 million. Supply less than 50%. Short volume trend is down. Price of at least $20. So that's the criteria that it's following itself, or that it's following for entries. And then for exits, it's either falling demand or rising supply from a 5-day perspective. Emails go out every morning before the open, and it looks something like this. Sorry. Get over to the actual portfolio. And bring it down just a little bit more. Sorry about scrolling down. So every day you'll have different entries and exits. And if we look at where we're at, where am I at right now? A little bit farther to go. Okay, so for today's entry, we were exiting ASML and Taiwan Semi, and we were entering into BABA and HCA, and then that would give us our five names that are currently in the portfolio. Some days there will be no names to exit, like today there were two. We're trying to gear it where you can have a little bit of a longer holding period. ASML is a great example. I think we held that name for about a week and a half. You can see the overall returns that we had in that name. Obviously, that's not going to happen every time, but that was a 14% return. One thing that I was doing with this one, as it started to rally, I was just slowly trimming that position back. And you can treat it just like it is and just wait for the entries and exits you want, or you can do a little bit of active investor trading at the same time. So I was slowly trimming it back. When I got out of my last part of it today, I had 17% gains. Now, obviously, that's not going to happen every time. That's a little bit of an outlier, but that's part of the point. As long as those criteria are being met, and once again, there's the criteria, and as long as it's not hitting an exit criteria, well, we can hold on to that name, and that's the potential. The really good momentum names, and with momentum names, sometimes you can get those types of returns. If we look at the performance year to date, here's our performance: 47, almost 48% versus the S&P 500, 14.3. And here's what it looks like from a chart perspective. So it continues to do exceptionally well. Even during the tariff drama, we were continuing to do better than the market even during that drama. So even if you're a little unsure, about whether to tag along, send myself or send Tim an email. Hey, we'd like to get signed up for it. Once again, it's for subscribers. And if you'd like to get signed up, you can just tag along and watch it for a week or two and see what you think. But it does continue to do really well. It gives you those defined parameters each day. Let me share, for those that are trading along with it, let me give you a couple of examples here. What I'm doing is as I go through this process, and maybe it will help you as well. So these are the current five names that we have here. So Baba was one of them this morning. It popped first thing in the morning, popped higher first thing in the morning. And then the question is, do we want to chase it when it's 4% higher? This is something that I'm doing. Maybe it'll be helpful to you as well. Uh, First 30, 45 minutes of the trading day, I'm picking up perhaps a quarter or a half of that position, depending on what's occurring during the day. And then I'm just picking moments during the rest of the day where I can just trade pieces. I did something similar with AMAT yesterday. That one got a little bit away from me, but I was thankful that I got that quarter position first thing in the morning. So that might be helpful to you. Uh, the the model itself is built on closing prices. So, this is built on closing price yesterday. You're like, well, I didn't get that closing price. Well, it's going to fluctuate, right? Sometimes you'll get a little bit worse on your entry price, but then sometimes you'll get a little bit better on your selling price. And we had our engineers actually look at it, and either whether it was closing price or whether it was midday pricing, the performance was roughly the same. So we have to have some type of model. The model itself is built on closing price, but once again, the performance has been extraordinary. So come and join us. Whether you want to participate every day or whether you want to paper trade. And one thing that you can do as well is just look at the names that are coming along every day, and then maybe you just want to trade those names yourself. You don't even have to follow the model. But I would encourage you just to tag along with us and see how it's going. Stop my screen sharing. Any questions, guys, about any of those topics so far, or anything else that you might have questions about? If not, we'll go ahead and continue kind of with our discussion. You've heard us talking a little bit about passive money the last couple of weeks. So when we talk about passive money, what are we referencing? And let me show you what this looks like. These are modern IR reports. Tim and I will try to bring the reports to your attention when it has something in the market, that's worth talking about. Here's one of the trends that's been occurring recently. So S&P 500, passive money. When we mention that particular bucket, think about index funds, ETFs, quant funds. That's what we're talking about. It's model-based activity that cares about characteristics in the market. What do we mean by that? Well, they care about characteristics such as market cap, such as volatility, such as sector. That's why it's being lumped into the passive investment bucket. What's the trend right now? Well, the trend is actually lower. So there's been lighter support from a passive investment perspective coming through this quarter to quarter transition. You can see that passive money has been elevated on a 200-day basis, both on 20 and 50-day levels, but it's lighter right now. It's a little bit of a question mark. So then the question is like, well, what's occurring then? You can actually see the same thing occurring for the Russell 3000. What's occurring is that fast trading is up. And one way that you can think about it sometimes is that the machines are going to go along with whatever the trends are in the market. And if the trends are higher, in other words, if no one's introducing supply into the market, well, the machines will just take the market higher. And that's what's been occurring here in recent trading. This is trading relative to midpoint pricing at the end of the day. And you can see that for 4 days in a row, might be 5 days in a row, we've closed above the midpoint. Once again, it's the machines that are doing that. What's happening from an investor perspective? They're just basically on the sidelines. They're not doing very much in terms of buying, but they're also not really introducing supply. So this is S&P 500. Think of that as the underlying stocks. Let's go to the ETF side for a second. This is the SPY. Slightly different from an ETF perspective. We are starting to get a little bit of active investor support. And what you see here, we call it trading patterns. Chris, one second. Thank you for the question. I'll be right with you. So we call this the trading patterns, and what it means, if you're above the zero axis, it reflects greater influence from that behavior. So what do we see? Well, we saw all that fast trading activity. We talked about that for the underlying stocks. And what we're seeing as well, just a little bit of active investor influence. What are they doing right now? Well, they're not necessarily buying the underlying stocks. They're buying the ETF. So they're switching over and buying the SPY basically as a proxy. And I wonder if that is part of what's kind of supporting the market at this particular time. In other words, in absence of normal passive investment flows, we're just getting a little bit of support from active money, and it's just enough to keep the market charging higher. Stop sharing for a second. Chris, I think you had a question. Fire away.
Yeah. Hey, Brian. Thank you.
Hi.
My question is, on the concept of new month, new money,
Yeah,
Is that mostly passive investment that's coming in?
yeah, it sure is. So, think about your 401k contributions. That's like a perfect example. Or sometimes you'll get quantitative investors that choose a period of time in which to invest every month. And the beginning of the month is a typical time frame when they would do so. And it's been working, on a 1 year basis, it's been working about half the time. And the last 4 to 5 months, we've been seeing those brief dips at the beginning of the month, and then the dips are just quickly getting bought. But you're absolutely right. What is that passive money? Tends to be things like 401k contributions.
Mm, okay, thank you.
Absolutely. Any other questions, guys, so far? Oh, I was going to share one item here. We talked about some of the fast trading influence. I'll take you behind the scenes for a second and share with you uh, some stats. So this is S&P 500. You're looking at trading statistics over time. Recognize that a round lot in the market is still right now 100 shares, but you can see what is happening over time. This is the 200-day average, 50, 20, and 5. Look at what's happening specifically with shares per trade. It's moving lower over time. Who does that tend to favor? Well, it tends to favor the machines. What would they prefer to do? Put less capital to risk at any given point in time. What did we see a lot of with the S&P 500 and the SPY? We saw a lot of fast trading influence, right? So the general conclusion, the machines are in charge. They're whittling trades down to very small increments. What type of market environment do you get with that? A lot of times one where like nothing's happening during the day, right? You look at trading during the middle of the day and it's like, wow, what, has everyone gone to sleep? And you look at what happens then from a sentiment perspective. Well, you just get that slow move lower. No one's doing anything except for the machines. But once again, they're not introducing supply into the market at this particular time. I did want to go back and share with you a couple of other times where the market has just been kind of stuck. I noticed it occurring two different times during the last year. One was here in mid-January, and you can see we were right there at 5. Let's see, that was the 10th all the way up to the 21st. So 11 days. Eventually, sentiment did climb. So we broke out of that. We broke out of it, to the upside. The other time, really, it's only two times, maybe three if we circle back to November back here. But the other time that it occurred was in February. Once again, that was right ahead of the declines that we started to see in the broad market. So we are at a little bit of an inflection point. When we're at neutral for the longest time, it stands to reason that we're going to break out of it one way or the other. We can break out of it to the upside, or we can potentially break out of it to the downside. So that's some of the risk that are out there at this particular time. From a context perspective, obviously right here, beginning of October, we're in the middle of a quarter to quarter transition. If you think about the market participants, especially from an active investor perspective, sometimes from a hedge fund perspective as well. Broad market's up 14 to 15%, on a year to date basis. What's their performance like? So you have to kind of go behind the scenes and you're like, okay, are they catching up with the S&P 500? Are they behind the S&P 500? If they're behind, they're probably going to start taking some chances during the fourth quarter to try to catch up. And as a general rule, well, active money is almost always behind. It's why they continue to lose money to passive investors My guess, whether it occurs right now or whether it occurs, as we move forward, I think you'll see investors trying to play that catch-up trade, either active investors or hedge funds. I'll go ahead. Let me stop for one other second here, see if anything else has come in. Fairly quiet today, which is perfectly fine. I'm either confusing everyone or it's very boring today. One of the two. Let me circle back to what the setup is as we look ahead. So a couple things to think about. If demand, and let me move this back to a view that we can see a little bit easier. If demand starts to heat up, so in other words, if sentiment starts to increase from these levels, well, we have low short volume. That would be divergence. That's obviously a good thing. But you can see part of what I was looking at when I wrote this morning's note. If I look across my portfolio, it's not great right now. There's my all equity portfolio at 5.1. There's Dow Jones at 5.1. There's large cap 5.2, Magnificent 7 below neutral. Mid cap is below neutral. Mega cap 5.3, triple Qs. I think it was maybe 5.4. Small cap 5.1. You get the point. But then when we circle down to big tech, and just as a reminder, why do we pay attention to big tech? Because it's about 35% of market cap for the S&P 500. And when big tech is weaker, you just get those general periods of weakness, especially when it's accompanied by the broad market at the same time. And let me circle, I don't think I showed you guys this. I keep a spreadsheet that looks at big tech over time, looks at the broad market. I'll show you those 4 times that I mentioned earlier to you guys. Just wanted to share what was occurring during those periods. So this was the period that I showed you earlier, and this is what I'm referencing. When the broad market is below neutral, when big tech is below neutral at the same time. Sometimes it can be a short period of time. This one it was only 3 days. It was returns of 75 basis points. This one was much longer, and this was during Christmas break, so I didn't have some of the data, but you can see big tech was moving below neutral. Broad market was very weak. If we look at that stretch, which really continued into the early part of the new year, what were the overall returns for that segment? About 1%. That was about a 3-week stretch. And once again, I'm showing you periods where both the broad market and big tech are below neutral. How does the market perform during those periods? That's the risk to me, is that we could be entering one of those periods soon. This was the period from mid-February, and we briefly went above 5 from a broad market perspective, but for the most part, we were below. So I'm just including the whole period. But you can see mid-February, and that stretched for over a month. So it was a very, very long period of time. How did we do from a broad market perspective? Well, we were down 4%. And then we go to April. April trading, of course, is when the market got, really crazy there for a period of time. You can see 2 days in a row, the whole market was down about 10%. And then we had 9% recovery in the middle of it. But if we look at that stretch, how did the market do? Including that 9% recovery, we were down over 6%. So that was also a very difficult period. That's the risk right now to me, is that if both the broad market and big tech get weaker at the same time, we could have one of those periods. Could it be something like we saw back in November? Could it be very brief in duration? Sorry, get back to November. Could it be something like this? Oh, sure. It could be very brief in duration, and maybe absolutely nothing happens. but I wouldn't be doing my job if I didn't tell you, the potential risk that are out there. One other risk that I just started to track, and if you're interested in getting these portfolios, please give me a holler afterwards, and I can share them with you. But I track two different portfolios. One of them is my friend Barry. What this portfolio does, it's tracking potential shorts at the higher end of the spectrum. So what I mean by that is demand. You've had really strong demand. It's up at 10. It starts to move lower, but short volume is increasing at the same time. The other short portfolio is one where demand is actually moving below neutral and it's moving below 4. So two different ends of the spectrum, one tracking really hot sentiment that's starting to cool off and short volume is increasing. This one is tracking weaker sentiment where short volume is becoming an issue. I bring this to your attention because it's only one day, but these numbers are starting to increase. The average for that portfolio is 19 names. The average for this one is 17 names. What are we seeing behind the scenes right now? Well, if we look at broad market sentiment, short volumes are actually moving lower. So in an environment in which short volumes are moving lower, we're actually getting potential shorts that are increasing. Is that a canary in the coal mine, or is that just one day? And you can see on the higher end of the spectrum, it has been, a couple of days. So I just bring that to your attention, just something to think about. Passive money, kind of the last subject for me, and I'll circle back and see if there's any questions. Will passive money start to return? I don't know right now. Passive money has been weak. This is the patterns look. This is the S&P 500. We've had about 3 weeks in a row where passive money has been missing. What I mean by that is they're not above the zero axis. They're not having a tremendous impact on pricing for the S&P 500. And once again, that trend line is lower. How much longer can the broad market move higher if passive money is missing? I don't have an answer to that question, but usually not very long. I think that's the main areas that I wanted to talk about. Let me see with the questions that have come in. Question from Joel. Do you think that because supply was so high for so long, the past couple of months, that this lull could be them reconciling those positions before they ramp trading back up? Joe, that's certainly a possibility. If you look at short covering in general, as a general rule, you think about those that are short shares. From an economic perspective, what would they like to do? Well, they would like to cover at lower prices. That's the general rule. When they can't cover at lower prices, well, they cover at higher prices, and it becomes a momentum stock. That's what you generally see with our momentum names, is it's hot demand and it's short covering at higher prices, and those stocks are just flying higher. But to your point, yes, this lull could be just short covering over time. And then if we get demand heated back up again, then you could see a continued rally here in the fourth quarter. Question from Joel, having trouble picking the daily momentum stock. Seems like each one I pick is the wrong one. Maybe you can go over that again. Great question, Joel. Let me share my screen with you. It's not a perfect answer to your question, but it's a way that's been helpful to me. So just as a reminder, so the momentum portfolio or momentum daily ideas, low volatility daily ideas, what is that tracking itself? We can see the criteria here. It's looking at the trailing 90-day data, and we're calculating odds for momentum on a 2% return in 1 to 5 trading days. In other words, if ASTS has 100% probability, It's looking at the last 90 days when we've had similar conditions and saying, okay, well, 100% of the time on a 90-day basis, when you've bought it down 50% or up 30% of daily volatility, it's gained 2% during the next 1 to 5 days. So that's the basic criteria, to think about. Couple things that have been helpful for me in terms of trading names. This is just a personal preference. Maybe some of you guys are better at this than I am. I try to stay away from the high volatility names. You can sort them by volatility. Um, I think ASTS about a week ago, I got burned on that one. It's higher volatility. What can happen sometimes with those higher volatility names? Well, you can have things like this. It can go both ways for you. You can get ASTS today that's up 16%, or you can get RIVN that's down 7%. So you do get sometimes extreme movement with momentum names. It's momentum for a reason. In terms of how can you treat those, what how can you try to pick the ones that are winners, and avoid the ones that are losers? One thing that's been helpful for me at the end of the day, and I don't know if this is going to be one or not. I got to move this out of the way. I'll take WBD as an example. So what I will do the last 15, 20 minutes of the day, I'm looking for names that are trading above midpoint pricing. This is just me personally. It's just something that's worked pretty well for me. I'm trying to get it on both a 1 day, 5 day, 1 month, and 6 month basis. So in other words, if I get underlying strength on a 1 day basis and I get it on a 5 day basis, 1 month basis, 6 month basis, that's a pretty good name to me. For Warner Brothers, probably not gonna buy this one. Now the math would tell you, and once again, it's just the math. Let's see what the math says. It's a 91% rate. So I'm doing something that goes above the exercise here. It's just a way that I've been able to get more winners and avoid, some of the losers. If it's helpful for you, great. If not, just go by the math. PAAS, let's take a look at that one. You can see on a 1 day basis, that's starting to rally. It's above midpoint pricing. What's it doing 5 day? Pretty good. What's it doing 1 month? Pretty good. What's it doing 6 month? Pretty good. That's something I would probably consider at the end of the day, possibly getting into a position. Joel, hopefully that's helpful. Once again, the math speaks for itself, but looking at underlying buying has been helpful for me. Can I address any other questions for anyone today? If not, let me just kind of summarize. Oh, okay. Thanks, Joel. I appreciate that. Uh, just wanted to summarize where we're at right now. To me, we're at a little bit of an inflection point. Uh, this inflection point is during a quarter to quarter transition. And once again, we don't know right now which way sentiment is going to go from a broad market perspective. I shared with you earlier, what big tech is doing and some of the occasions where that's been an issue when we see big tech below neutral, and we see broad market sentiment below neutral at the same time. So I'm carefully watching this trend to see if we move below neutral. It's been just slowly grinding lower. Could we move higher from these levels? Absolutely. What could be part of the impetus for that? Well, once again, from a context perspective, you think about active investors and hedge funds that might be behind broad market performance. And if they're playing any kind of catch up, they're going to try to peel into some of those hotter sectors and try to catch up to S&P 500 performance. So once again, inflection point activity right now. We don't know which way we're going to go. I wouldn't be doing my job if I didn't share with you some of the risk factors that we've seen, in the past. Well, guys, with that, I think I will bid you adieu. Thank you very much for your time today. I really appreciate it. Once again, we're always available for questions. If you do want to tag along with us in the Edge Focus portfolio, can you just send me an email afterwards, and I'll make sure that you get signed up for that. I'm going to go ahead and stop the recording, and I thank you once again for your